Some people have asked me to do a piece on real estate investment trusts. I like to give the people what they want, so here it is. A real estate investment trust, or REIT, is a type of trust structure. A trust is basically a collection of individual investors who pool their money together, give it to someone who knows about a particular type of asset, and that person or that company goes off and buys assets on that group of people's behalf. That's it in a nutshell. Most of the real estate investment trusts in Canada specialize in a particular type of asset. So you'll have a real estate investment trust that specializes in shopping malls, for example, office towers, commercial property, seniors facilities, or whatever. Any type of asset, any type of real estate asset you can name, there's probably a REIT structure associated with that allows you to have access to the economic benefits of it. In my opinion, there are 4 primary benefits to real estate investment trusts. First, and most importantly, they give individual investors access to assets that they wouldn't otherwise have access to because they couldn't afford it or for legislative reasons or whatever. Unless you're building your own shopping mall, they give you access to shopping malls across Canada, senior care facilities across Canada, and the rental income from that. So they give you access to stuff that you wouldn't otherwise be able to buy as a standalone individual investor. Secondly, and this one's very important, as I've said on many occasions on this channel, real estate is a terribly undiversified asset, right? So you've got 90% of your net wealth in one instance of one asset class in one neighborhood, in one city. God help you if something bad happens to that city or the economy of that city, the value of your assets is under threat. With a real estate investment trust, you've got diversification because you're buying assets all across the country. The third great benefit of real estate investment trusts is that the cash moves in the right direction. And what I mean by that is that instead of having this piece of real estate and then paying a contractor to repair your roof, or paying the city because they assess the value of the thing differently, you're actually receiving rental income. So the cash moves in the right direction. It's a great way to participate in real estate, but generate income at the same time. I think the fourth benefit is a little more subtle, but basically real estate investment trusts are quite liquid relative to other types of real estate. So, you know, you're getting a job on the other side of the country and you need to sell your house. It's going to take you months to go through that very painful process. Whereas with a real estate investment trust, if things go wrong with it or you decide you need the cash, you can sell it in under a minute. That order will be transacted for you. They're quite liquid, and so you don't need to hang on to something as the ship is sinking. Of course, it's not all sunshine and lollipops with REITs either. This is real estate, right? So think about it. You're buying access to, or you're buying into a pile of real estate, specifically real estate that's got tenants in it, and you're receiving income from those tenants. And what are the implications of that? Obviously, the first thing you want to think about is what are the quality of the tenants that this real estate investment trust has? Are they so-called anchor tenants if it's a shopping mall complex? Have you got tenants like Canadian Tire and the Bay and so on? Or is it more risky single shop retail shops that may be a bit more spotty in their rental record? That's one thing you want to keep in mind. Another thing is how much leverage does the real estate investment trust employ? How much debt have they got? So you want to look at what's called their capital structure, which is just a fancy way of saying of the assets that they have, how much of them do they actually own and how much of those assets are levered by borrowings from a bank or someone else. The way you look at that is something called the NAV or net asset value. When it comes to buying a REIT or any other type of investment for that matter, you want to look at how solvent the company is and how liquid the company is. Basically, you want to find out whether the company is generating sufficient cash to meet its obligations. You get that typically from the funds from operations section of the income statement, or excuse me, of the cash flow statement. Basically, you want to find out, is this company able to meet its short-term and its long-term obligations? And lastly, when you look at investing in a REIT, you want to look at how much free cash flow it generates. You want to look at the rate at which it spins off cash, because it's that cash that you're going to be receiving, and it's that cash, that ability for this real estate investment trust or REIT that'll hold up the value of the asset, because assets are the net present value of future cash that you're going to receive. And so the more cash that you receive, or that people expect that you're going to receive from this investment, the higher the value of the REIT is going to be, or the more easily it's going to maintain its value over time. I generally speaking like real estate investment trusts, though I don't own any at the moment. They diversify you and they generate income for you, and that's always a good thing, especially in the low interest rate environment that we're being exposed to now. So that's pretty much it for real estate investment trusts. If you have any further questions about them, leave them in the comment section below and I'd be glad to answer them. Also, if you are a non-resident who is interested for some reason in buying Canadian real estate investment trusts, there's some different rules around that for you. So send me an email and I can talk about it. As usual, thanks very much for watching. See you next time.